Hello friends, let's begin with another topic of international taxation, that is transfer pricing. Yes, before we start, let me give you some clues about the short form I used in this entire notes. That is, the very basic TP is for transfer pricing, ALP is for arm's length price, ATP, that is actual transaction price, NR is for non-resident, A is for associate enterprise, and ED is for executive directors, GP is for gross profit, NP is for net profit, ENT dot is for entity, TV is for transaction value, and these are some full forms of the methods which we use to calculate ALP. So I will let you know them while reading the notes. Okay, so let's begin. Transfer pricing. It's applicable only when there is specified domestic transaction or international transaction between AE, that is associated enterprises. So let's see what we mean by specified domestic transactions. Okay, transactions referred in section 80A, 80IA subsection 8, 80IA 10, chapter 6A section 10AA, to which 80IA 8, 80IA 10 applies. Provisions of these sections are applicable and other transactions as may be prescribed. Okay, international transactions, but I think before that we should see what is exactly AE. So AE means associated enterprises, means the two entities which either of the one holds minimum 26%. I hope it's visible. Okay, yeah, holds minimum 26% share capital of entity, or holds minimum 26% share capital in each of such enterprises, appoints more than half board of director, or appoint one or more executive director of entity or each of such entity. Total assets more than equal to 51% from loan obtained from entity. Guarantee of at least 10% of the total borrowings. Raw material minimum 90% from one enterprise. The company is totally dependent on know-how, patent, copyright from another company. Sell price is influenced by another company. Common control on both of the entity. Minimum 10% interest in firm AOP or BOI, or any mutual relationship as may be prescribed. Now we will continue with our very important part, that is international transaction, that is transaction between associated enterprises and at least one of them is NR. Here at least one of them is NR is being said, but the exception is that if both are NR, only it is a international transaction only if its income of at least one NR is taxable in India. If there is if the transaction is between one resident and another non-resident, then the transfer pricing provisions are applicable. But if the transaction is between resident and resident, then it is not considered as an international transaction. Further, the transaction must be at ALP, that is arm's length price. methods to calculate arm's length price are cup method, RPM, CPM, PSM and TNMM. So I told you I will tell you the full forms at the same time. CUP is comparable uncontrolled price, CPM is cost plus method, RPM is resale price method, PCM is profit sharing method and TNMM is transaction net margin method. Always one should remember that while calculating ALP by any of these methods, we should start it from untainted price, that is unbiased price, and we have to adjust plus or minus the differences which will probably increase our income or decrease our losses or expenses, and then we will be reached to ALP. In these three, probably in RPM, CPM and TNMM, we have to find the gross margin, which is the percentage on operating cost or sales, as the case may be, and similarly we have to adjust our prices to reach ALP. Okay, so now next is ALP not apply if there is reduction in income or increase in expenses or losses. That means your your income with the actual transaction price is higher uh, before before applying ALP, then ALP will not be applicable. We can get one or more ALP. Before that I missed out one statement, that is एसएससी का फ़ायदा बिल्कुल नहीं होता जब एएलपी में बंधा जाता है. यानी कि अगर एएलपी से हमारा इनकम कम हो जाए एज ए एसएससी या हमारे एक्सपेंसेस बढ़ जाए तो वहाँ पर एएलपी नहीं लगता. ओके, so now shifting to that next, we can get one or more ALPs by using above methods, or then we have to take the average ALP. If the tolerance band, that is ALP to ATP is 3%, arm's length price minus actual transaction price is also known as excess money, and if such excess money is less than or equal to 3% of actual transaction price, then actual transaction price will be considered as arm's length price. Steps to calculate the average ALP: arrange the data in the ascending order and number it. Dear friends, you have to do this only if the dataset contains more than 5 values. I mean, if the data set contains 6 or more than 6, then you can use this method. You have to arrange the data in the ascending order. You have to take 35% or 65% of the numbers in the data set, and if this percentile comes to the fractional number, then you have to take the value assigned to the next number, and your actual transaction price, if it falls within this 35 percentile and 65 percentile, then we can say that the ATP is in range and ATP is equal to arm's length price. But if ATP does not falls within this range, then you have another option. You have to calculate the median, that is 50% of number of data sets, and if it's a fraction, then you have to select the value of the next number. But in all of the above conditions where the percentile we take, if instead of getting fractional numbers we get whole number, then we have to take average of values assigned to such number and the immediately next value. Specifically in these three kinds of method, that is in cost plus method, resale price method, and the transaction net margin method, where gross profit margin is to be taken and data of more than a year is given, take weighted average, that is total operating profit upon a total operating cost, and then follow same steps to calculate ALP as given above. Over here in these three methods, you have to take the weighted average of the year, that is current year and previous 2 years. Arm's length price is determined by SSC on its own, or it's determined by AO with reference to TPO by prior approval of CIT or PCIT. If AO determines ALP in the following cases: if SSC fails to compute it by most appropriate method, if incorrect data is used to calculate ALP, if the documents not maintained or furnished, if not submitted, then OOBH is given, opportunity of being heard. OOBH means that opportunity to SSC is given, and then the further it is decided. Well, the documents means transfer pricing study report, that is TP study report, which is maintained for 8 years, and it is made only if the transaction value in the entire year is more than 1 crore. It is not filed with the return, it is submitted only if called by AO or appellate authority in 30 days. This time limit may be extended by another 30 days. And the next document is master file, which is filed by a constituent entity. Okay, effects of determining ALP by AO. If income is increased by AO, then no effect on other AE, that is price charged, or which is in the another AE's income, which is not affected, and there will be no deduction allowed under section 10AA and under chapter 6A against such excess money, that is increased part of income. The order of TPO is binding on AO. TPO is one of the officer who is responsible for determining ALP. He calculates ALP and submit reports to AO, and this report or this order is binding on AO. TPO can consider another international transaction also which are not referred by AO if it comes across the procedures. TPO should pass order minimum 60 days before time available with AO for completion of assessment, and if it is not and if the order is not passed before 60 days, then the time limit to complete the assessment is increased or extended up to 60 days? Well, here I have written the CBC report part because it is connected to the constituent entity. That master file is being basically mean the constituent entity is the entity which do not have its parent company in India. Like example I have mentioned over here is HUL, Hindustan Unilever. Okay, the constituent entity, the entity which is having its working in more than one country, and then it has to submit country by country report. But again, there is a condition. CBC report is only submitted if the group revenue is more than 5,500 crores. It is filed within 12 months from the end of the accounting period, and of course filed by parent company if the parent company is Indian company or any alternate reporting company. So if these reports are not submitted, whether it is TP study report, master file, or CBC report, then we are supposed for the we are exposed to the penalty, and these are charged under section 271 GB1, 23, 270, 271D, and many. These penalties will be discussed in some another revision, or I will make a proper notes for another notes for the penalties especially, and I will cover this part over there. Okay, SSC on whom TP provisions are applicable shall file the return before 30th November of the assessment year, that is due date under section 139(1), along with the CA report in form 3CEB. Here are again some short forms I used in this entire new page, that is APA is advanced pricing agreement, PA is primary adjustment, which you can say that excess money is equal to ALP minus ATP added to the ATP is again equal to ALP, and MFP is mutual agreement procedures. Okay. Now we are moving to the another part, that is APA, that is advanced pricing agreement. So the charts begin from here. CBDT can enter to any person for APA with the prior approval of CG. APA, if obtained by fraud, can be cancelled with the prior approval of CG by CBDT. APA can be entered only for international transaction and not for the specific domestic transactions. APA is binding on SSC and IT authorities up to the level of CIT and PCIT. It is not binding only if there is change in law or facts. APA is applicable for for 5 years. But one another option is also available, that is rollback option, which is available for last 4 years. APA once entered is compulsory for next 5 years, but option is available whether to go for rollback or not with the SSC, and if CPTT allows, to go for the rollback. Rollback is allowed for similar transactions. If rollback takes place, we have to file modified APA written, modified advance pricing agreement written, within 3 months from the end of the month in which advance pricing agreement entered. Reassessment for such period, for the rollback period, can also be done, and for such 1 year from the end of the year in which the modified return is filed is allowed. Conditions to avail the rollback. If the following conditions are fulfilled, then only one can go for rollback. First condition is there should be similar transactions. Another condition is that your original return of that year must be filed within the due date of 139(1). 3CEB, that is the CA report, must have been filed. Returned income. Because of rollback, if your returned income get reduced, then the rollback is not allowed for that year. If your assessed income gets reduced because of rollback, then you're eligible to take the rollback benefit, but only up to your returned income. Your returned income cannot be reduced because of rollback application. For any of the rollback period, ITAT, that is Appellate Tribunal, had passed its judgment for any of the rollback year, any of the year which falls in the rollback period, then no rollback provisions is applicable for such year. It's not optional to opt for 1 or 2 years out of 4 year in rollback period. You have to apply rollback provisions for all the previous 4 years. Only the exception is that where there is no international transaction or any of the above condition is not fulfilled or any of the above condition is violated. If you are existing in rollback period, then only you are eligible for the rollback option or rollback provisions. This point is related to the merger and demerger cases. If you're merging two companies and forming a new company has applied for the APA, then that new company cannot go for rollback. And in demerged company, if again the new entity which is demerged and formed a new company, if such new company is applying for the rollback, then even that for APA, then even that company cannot go for rollback. And now the another new topic is the secondary adjustment. Section 92 CE says about the secondary adjustment. Secondary adjustment is only done if primary adjustment is more than 1 crore and it is done after assessment year 17-18. and the primary adjustment to actual transaction price made by AO, advance pricing agreement, or mutual agreement procedures, or by safe harbor rules. Secondary adjustment is the adjustment which is done as interest income on excess money. Excess money, that is, we know the difference between actual transaction arm's length price and actual transaction price. So this excess money should be repatriated to India from the associated enterprises. Now it can be repatriated to India by any non-resident associated enterprise within the prescribed limit, that is 90 days. Such excess money is repatriated to India, not repatriated to India. If it's repatriated to India within 90 days, it's well and good. If it is not repatriated to India in 90 days, then consider such excess money as loan to associated enterprise, and interest on such interest on such excess money added as income every year. uh, you have another option to pay tax on such excess money at 18% tax rate plus surcharge 12% plus higher education cess at 4%, and no credit available of such tax, that is same as DDT, dividend distribution tax. Over here, interest is charged at the rate. If the transaction value is determined in rupees, then you have to take on 1st April of the previous year 1 year SBI lending rate plus 3.25%. And if the transaction value is denoted in any foreign currency, that is other than rupees, then you have to take the interest rate as on 30th September of previous years, that is 6 months LIBOR plus 3%. This interest is charged for entire period, not after completion of 90 days from such adjustment. "90 days" calculation, it depends upon by whom the primary adjustment is done. If the primary adjustment is done by AO or appellate authority, then you have to calculate the 90 days from date of order. If primary adjustment is done because of advance pricing agreement, then due date under section 39(1) is gone. Then end of the month in which AP advance pricing agreement is entered, and if the due date has not been gone, that is, we have to still file the return, then the date of filing of ROI. If adjustment is done by MAP, then the effect of MAP given by AO, and in others, due date of filing ROI under section 139(1). These are the dates from where we have to calculate 90 days, which is available time for repatriation of the excess money from our associated enterprises. Under section 273B, it is said that the non-levy penalty, if cause for the failure proved. That is, if any of the SSC is receiving indirect benefits from transferring its asset in any another country, then such income which is not taxable in India can be taxed in the hands of SSC. And the last section 94B, that is uh, maximum interest deduction allowed is 30% of EBITDA, that is earning before interest, tax, depreciation and amortization. This interest is on debt by non-resident associated enterprises, and interest should be more than 1 crore. This provision of 30 per this restriction up to 30% of EBITDA is not applicable for any Indian company or PE, and if such expense is disallowed, then it can be carried forward for the further years. Thank you.